A lotto means that you spend what you're willing to lose, and typically also means that there is massive returns incorporated. If you're going to take a lotto, you want your target for the trade to be something crazy, right? And you're usually spending a very small amount of money that you're willing to just straight up just set it on fire. When you take the trade, you have the mindset of it's probably going to zero, but if it does hit, it's going to be huge. I would control in your early days of trading lottos to a minimum, because it is what we're doing in many ways is gambling, but we're smart gamblers, right? You're basically becoming a professional gambler when you become a trader. So what you want to do is not become a gambling addict and be constantly trading lottos. You want to be following a plan. And following a plan, for me, incorporates having a rating system and keeping my lottos to a minimum. So let's take a moment and talk about lottos. Now, I've talked to a lot of great traders, some of the best in the world, and some of them are very critical of for people in our position to talk about things like lottos and what is more of the gambling side of trading. I disagree with them, and I'm going to say I'm not encouraging you to take gambling. We should take it very seriously. We're talking about trading, talking about developing something like a gambling addiction where you're just going for wild plays all the time. But I also at the same time want to recognize that there is a fun aspect to, like, okay, this is a little lottery ticket. It might play out wildly, but I'm going to be responsible in spending what I'm willing to just lose. Okay, when you buy a lotto, you're basically taking some money right out of your wallet and you're saying, I am going to set this on fire. It's gone. As soon as I buy it, it's gone, right? That's what you just did. If it plays out, holy cow, a little birthday present, a steak dinner, sometimes bigger than that. I have posted and shared times where I've gotten 3,000% on some trades. And typically those are lottos. They have huge payouts. So let's talk about how you can maybe skew those odds in your favor by using the most popular type of lotto play people like to go for, and that's trading into earnings. All right. And how to even identify when trading into a company's earnings is not actually a lotto play. And this might be a little too basic for what I want this course to be, but obviously 4 times a year companies report earnings, right? And you can see, like a stock like Snapchat, how insane these earnings moves can be. That's a 40% move, literally overnight. You wake up next morning, the stock is down 40%. If you're in a leverage position, which is what options are, they're a leverage position, you're going to make a killing off of that move, right? If you actually utilize these rules. So the first thing is understand you have to marry 2 things. You have to know how to calculate how much of a move the stock is pricing in by using the options chart, which we'll go over. And the next thing you want to do is whatever stock you're looking at, you want to get an idea of what the average move on earnings is for this stock. That could be as simple as just looking at the previous 8 earnings and going here and saying, okay, we got a 47% move there. We've got a 28% move there. We've got a 38% move there. We've got some smaller ones. So we got a 16% move here. We've got a about a 20% move there. Okay, and we've got an 18% move there. That's 1, 2, 3, 4, 5, 6. Let's get some more examples in here. So we have a 42% move there. I think we skipped one. Right here, we have an 11% move. Okay, so let's derive a average off of this. 42 plus 11 plus 19 plus 20 plus 16 plus 38 plus 28 plus 47 divided by 8. So we have an average of a 27% move for Snapchat. So now we're going to do some math. All right. So we've got an average of 27% on earnings moves. So now we're going to pull up the option chain for Snapchat. We're going to look at the money calls and puts. So we're currently at $11.13. We're going to look at the price of the puts here. They're $22. The price of the calls is currently $36. That's going to give us 58. So now we're going to take 58 and we're going to divide that by the current stock price of $11.13. And that's going to give us probably something close to 0.19, which is about a 19% move. So right off the bat, we can look at what the market is pricing in, which is a 19% move. And we can look at the average percent move for a stock like Snapchat. So this, if they had earnings, they don't have earnings in the next week, but if they did, had it, let's say on the 16th, you could buy these contracts for the 18th, maybe even play both sides in what's called a strangle, where you buy maybe a $12 call and you buy a $10 put, and the likelihood that it plays out your favor is extremely high, given the fact that typically the stock moves 8% more than what is currently being priced in. But it's so important to remember that your math doesn't end there, right? Because what happens when clarification, remember, earnings report comes out, there's all these expectations built into it. You calculate what the expected move is, but when the report actually happens, there's going to be uncertainty priced out of the contracts. And that is represented through a loss of implied volatility, which you could measure by the change in Vega, right? So let's just do an example equation. We're not going to run Snapchat as an example because the math's going to be all weird since we don't have earnings coming up. But just as an example, we have the expected move of 19%. We're going to multiply that, which we should actually use a dot there. We're going to multiply that by what the actual move is. Whatever you believe the actual move is, or you can do what the average move is for the stock. And then this will give you a variable, right? This will give you some sort of answer, some sort of y. We'll redo my y. My y is very dirty. You want to take this y variable and you want to multiply this by the implied volatility. Let's say you bought the calls. The implied volatility is 51%. Very important that you do not use the decimal here. So we'll use the 51.949 rather. This will give you a z. Then you take the z times the Vega. And this will tell you the loss of contracts. Loss on your contracts, right? This is how much you lose with the clarity being brought to the market. And this needs to be greater than what you make from your delta. So let's represent this with a B. So then you want to do B minus the change of the delta that's being built into the contracts, because you got to move to the upside. So the contracts are going to go up relative to the delta. Remember, this isn't going to be an exact calculation because you're also not building into the price of the gamma that reflects on the delta, which then reflects on the price of the contract. But once you do this math, so let's say it moved 2%, so it moved $2. So you're going to do you would do 2 times 0.59. Because that's the delta for our $11 contracts here as an example. And then this number will be the value, expected value of the contracts. So if that was a bit confusing, I'll provide an example also in a PDF file that you can download so that you can run through these calculations on your own when you're playing into earnings. Very important to know, because it'll save you from doing a lot of dumb things if you take the time to run the math. And once you get used to doing these equations, it doesn't take long. This might be a bit confusing. Trust me, you'll pick it up fast.